All right. I'm going to make some introductions here. Thank you, everybody, for joining us. Today, we have Andy Scott, and Andy is a lawyer with the Scott Law Firm. He has over 15 years of experience. He has set up all sorts of professional corporations as part of his practice, passed for dentists, doctors, accountants, and other lawyers. He also practices in the area of finance law, mergers and acquisitions, and sports law. We also are lucky to have Jacob as well. Jacob is a partner at Henry Warren LLP, works with a diverse client base, and provides a wide variety of services to businesses and business owners in countless industries. He is an income tax specialist, and he can assist you with income tax and estate planning, corporate reorganizations, case-specific research, and making representations to tax authorities in connection with audits and appeals. Thank you very much, gentlemen, for being here, and we're very much looking forward to this.
Thanks very much. Hey, thanks for having us. And if my brother's on the line, I think he deserves a little bit of credit here because he really put the new legislation on the radar for me about a year ago. He indicated that OREA was lobbying the government for the opportunity for realtors to incorporate, and I've really tracked the legislation as it's made its way through the legislature since that time. And when the regulations came down regarding what the rules would be in terms of how realtors can incorporate, my initial reaction was, this is great news for realtors because they're a lot more attractive than the rules and regulations with respect to lawyers and some other professionals. There's just more flexibility. And Jacob Malasic, who I'm happy to be co-presenting on this topic with, can walk through some of those advantages in the presentation today. I'm just going to share my screen here with everybody. We have a slide deck, and really it goes through the nuts and bolts of personal real estate corporations. Andrew, can you see my screen now?
I can.
Perfect. So, today we really just want to get into, I really want to assume nothing in terms of what everybody understands about corporations. So I want to talk a little bit about the basics of incorporation. Then I'll hand it over to Jacob Malasic, who is a partner at Henry Warren, a tax expert, and Jacob and I have worked on so many files together, and it's very seamless, and I think that's what's attractive about to some of our clients, the fact that we work so great together. But he'll talk a little bit about that, about income tax considerations. Then he'll come back to me and I'll talk about the ins and outs of the actual personal real estate corporation. So to start things off, the most popular question we get as corporate lawyers is, should I incorporate? If you're starting a new business, there's the opportunity to operate that business as a sole proprietorship or a partnership or through a corporation. And really the response is a typical lawyer response, and it's that it depends on your particular situation, your particular needs. And the hope is at the end of this presentation, you'll have a better idea as to whether incorporation might make sense for you. And if you don't, you can always call myself or Jacob, and we can talk offline about some of your questions or your particular situation, and whether whether again incorporation will make sense. But just some basics of incorporation. So first of all, you have to think of a corporation as a separate legal entity. It really does carry some of the same rights and obligations under Canadian law as a natural person. It can sue somebody, it can be sued. It needs to file a tax return. It can own property, it can sell property. You really have to look at it as its own separate legal person. A second attribute of a corporation is that it has limited liability. And this is important because the liability is really limited to the amount invested by the shareholder. It's a separate legal entity, and as a shareholder of that entity, there's something called the corporate veil, and it's very difficult to pierce the corporate veil and go after the shareholders of a company unless there's fraud involved and that sort of thing. So there is limited liability when it comes to corporations. So more basics of the incorporation. Corporations have a complex, or can have a complex structure with a number of stakeholders. First of all, directors of a corporation really manage and supervise the company. And sometimes there's a board of directors that together they really look at high-level strategy and supervise the management. Whereas the officers of a company, thinking of president, vice president, secretary, some other titles are CEO, chief executive officer, CFO, chief financial officer. Those officers are tasked with managing the day-to-day operations of a company. And then lastly, you have shareholders that are the owners of the company. And here, you just have an example of the different types of shareholders that you can have in a company. So you can have a trust, a family trust owning shares of a company. You can own your shares personally. You can have a holdco, so a company owning shares of this company. And then up here, you might have this person owning the shares of the holdco. Or you can have all three. And so there's going to be advantages to setting up your corporation so that you could really take advantage of some of the things you would like to do now that you have the right to incorporate. One example is, if you're paid into your personal real estate corporation and you really want to start some significant investments in real estate with these funds, you can send up an intercorporate dividend to your holding company. Intercorporate dividends pass tax-free, and if your holding company is a shareholder of your PREC, you can really strip the cash out of your PREC, get it into a holdco, and invest from there, for instance. So more basics of incorporation. I mentioned directors and officers. Under the personal real estate corporation rules, you as a realtor are going to be the sole director of the company, of the PREC, and also the president, act as president of the PREC. And as a director and officer wearing those hats, you're opening yourself up to some liability with respect to things like source deductions, HST, vacation pay, unpaid wages for your employees, just different things you need to be aware of when you're operating your company, so that you're taking care of all the different obligations of the company that could make its way and for which you could be personally liable. There's also higher startup costs and ongoing costs when it comes to a corporation. Your legal and accounting fees, your fees to maintain your minute book on an annual basis, preparing and filing income tax returns for the corporation, and finally preparing financial statements. In terms of the procedure to incorporate, a common question is, how do I go about doing this? How do I go about getting the advice? My recommendation is your first stop will be to talk to an accountant and a tax expert like a Jacob Malosic about organizing your company properly and getting the optimal structure when it comes to advantages for tax planning. So that may involve, as I mentioned before, you may have a family trust as a shareholder, and you as a shareholder personally. You may have a holdco. You may have some family members, your spouse as a non-equity shareholder. You may have your spouse as a beneficiary of the family trust that you set up. There's a lot of different things to consider here, and I know you're in great hands with Jacob. Jacob would then, or your accountant, would then communicate with your corporate lawyer, likely send a memo to your corporate lawyer, a letter, basically summarizing how this company is going to be set up. And your corporate lawyer would then draft the articles of incorporation, the bylaws, resolutions, share certificates, and make sure that your company is properly set up. And then your corporate lawyer will also update your minute book on an annual basis, make required filings with the government, and your accountant would obviously help you with respect to tax returns and the like. But that's typically how it works when you incorporate, and if you have an accountant and a lawyer working together, I think it can be pretty seamless. I'm going to kick it over to Jacob Malosic now to talk about some income tax considerations, and then I'll talk about some information you need to know specifically with respect to your personal real estate corporation.
Great. Thanks very much, Andy, and thank you everyone for having us on. Just want to echo those sentiments and thank you for listening in. I realize that the topic of income tax is about as exciting as going to see your dentist. It's one of these things that we like to do once or twice a year and keep it as short and painless as possible as we can. I want to touch on what I think are the highlights of incorporation. My goal in this kind of summary is for you not to get lost in the numbers, but just to focus on some of the concepts I'm going to be talking about. And then to Andy's point, this discussion of does a corporation make sense really comes back to specific circumstances and your own unique situation. And so what I would encourage everybody listening in to think about is that if you're on the fence, well, does incorporating make sense for me or not? Just pick up the phone or shoot an email off to either myself or Andy, and we'd be happy to chat further about your specific circumstances. At a high level, this idea of incorporation, the corporation is going to think of it as a separate entity where all of your income is going to start being funneled into. Okay, and the idea here is that hopefully there's some tax advantages associated with doing that. And in order to understand what those tax advantages are going to look like, we have to think about this concept of integration. So the theory of integration is that the Canada Revenue Agency, they're reasonably smart folks over there. They obviously don't want to lose tax revenues by people simply setting up a corporation and manipulating the tax system. So the tax system is set up such that if a dollar flows into a corporation and into the hands of an individual, that person should be relatively indifferent versus just earning that dollar straight directly and putting the money in their pocket. That's the theory, and certainly in Ontario right now, that's the way the income tax rates kind of shake out. Meaning that if a dollar of income flowed through a corporation into somebody's personal jeans, they're going to be relatively indifferent in that specific year. But this theory of integration breaks down for three key reasons. So there's this idea of an income tax deferral, what I'll refer to as income smoothing, and the possibility to split income with lower income family members. So the first advantage is an income tax deferral. So on the first $500,000 of active business income within a corporation, in Ontario, the combined corporate tax rate right now is 12.5%. Any income over 500,000 is taxed at a flat rate of 26.5%. When we compare that to what you'd pay on an individual side of things, well, as individuals, we're taxed in Canada on a graduated tax rate system. So what that means that somebody that's earning maybe little or no income might pay no tax at all. On a sliding scale up to somebody earning 220 grand or more per year, well, on each marginal dollar of income, they're paying 53.5%. About you folks, but when I hear 53.5%, well, as a tax planner, my spidey sense goes up, and that's where I try and look at that and say, well, can we do better than paying more than half our income to the government? So in this simple example, in the left-hand column, there's a column that says individual. So let's just take a simple assumption that somebody earns $200,000 as an individual, so no corporation. There's little tax planning that can be done in that scenario. They'd pay roughly $69,000 in tax, and they'd pocket about $130,500 after tax. In the two columns on the right-hand side of the screen, let's take that same example where rather than an individual earning the $200,000, let's assume they've set up a PREC and the $200,000 rolls into the corporation. They pay out $100,000. Let's say they take $100,000 as a salary. So that's deductible at the corporate level. They're left with $100,000 that's going to be taxed inside the corporation, and $100,000 that's going to be taxed in their personal hands as in the form of salary. Well, when we work through all the numbers, you can see that the corporate rate that's applying to the $100,000 of corporate net income is only 12.5%. And the other thing that happens is because their overall personal income is lower, the average personal tax rate has come down quite significantly as well. Such that when we add up the total corporate and personal tax in this scenario, we're about 33 grand less. So we've deferred $33,000 in tax. Now, the key thing I want everyone to understand is that the story doesn't end there. Eventually, that money that's been retained in the corporation, so the $87,500 amount net of corporate tax, eventually that money has to come out of the corporation, right? And it would come out as either a salary or a dividend, but the benefit we've really attained here is being able to reinvest that 33 grand so we can go out and buy shares of Bell Canada, maybe a rental property, something like that. But we're doing that with pre-personal tax dollars on that money, giving you more capital to use to invest. A lot of people, what I say to a lot of folks is to think of this income tax deferral a lot like an RRSP. So people are relatively familiar with an RRSP, the concept being that if I contribute to my RRSP, I get a tax advantage of an immediate tax savings or deferral. And I know that sometime later, you know, presumably in retirement, when I draw that money out of the RRSP, it's going to be income in my hands, right? So it's very similar in this case where by retaining money inside a corporation, sure, we know that we have to pay tax on someday down the road, but we can time that extraction of the funds at a much later time, hopefully, you know, in retirement when our income's lower. The second consideration that I want to bring to everyone's attention is something called income smoothing. And what we're trying to do here is that because our graduated tax rate system as individuals is a sliding scale upwards, rather than have a case where your income is lumpy, like very high in one year, low the next year, high the next year, there's going to be a very big tax advantage just by being able to simply smooth that income personally over time. So that this smoothing concept can be 1 year to the next, or it can be a longer term view of your current working career versus retirement. So certainly you don't want a situation where you've got really high income personally currently and then no income in retirement. What we'd want to do is smooth our income and use all those graduated rates that we can all along our life cycle. So we'll walk through a simple example. There's lots of numbers and writing on this slide, but don't get too lost. Let's just assume a very simple scenario where maybe due to market conditions or some other reasoning, somebody's expected income in 2021 is going to be 300,000 and it's going to be 100,000 in 2022. If we did nothing and the person earned all that income as an individual, no tax planning can be done and they're going to be left with approximately $146,000 in total tax that's going to be owing. If we assume the same $300,000, $100,000 of income, but now we're going to earn that money inside a corporation. And all we're doing in this example is we're going to pay $200,000 of salary in each of those years. So we're still drawing all $400,000 out over the 2-year period, but we're maintaining a smoother level of personal income at $200,000. Well, when we run through the numbers at that level, your total tax is going to be about $139,000. Resulting in a savings of close to $6,700 in a very simple 2-year example. The other thing that's relevant when you talk about income smoothing is that a lot of government benefits and credits are based on personal income levels. For whatever reason, they don't look at, well, what was your corporate income in a given year? They're looking at your personal income. So things like the old age security or perhaps the Canada Child Benefit, which are income tested, this becomes a positive of being able to smooth your income because you can manipulate your personal income year over year to get it to the level you want to best take advantage of certain government credits. The final advantage is something that's called income splitting or income sprinkling. So in the ownership of PRECs, one thing that you guys have a huge advantage of that lawyers and us poor accountants don't get the advantage of is the ability to have family members own shares in our professional corporations. You guys can have family members hold dividend paying shares directly in your corporations. So that's a big win. Prior to 2018, it would have been an even bigger win. And the reason for that is that in the past, what we were able to do is have family members own shares. And if one family member was a high income earner, such that they were paying maybe the 53.5% marginal tax rate, and there were other family members that had lower income levels, simply by shifting some of the high rate income over to the low rate income. And the way we did that was by paying dividends to those lower income individuals. Simply by doing that, the net overall tax burden of the family came down significantly. So the more lower income family members you had in there as shareholders, the more advantageous that this kind of planning would be. Again, the government obviously didn't like that kind of planning. And so at the start of 2018, next slide, Andy.
Yeah.
Start of 2018, they introduced expanded rules of what I'll call the tax on split income, or the TOSI rules. And where TOSI applies, essentially any dividend that's paid to a family member is going to be subject to the very highest rate of tax on that dividend income, thereby defeating any benefit of trying to income split with that family member. That's kind of the idea. Now, this concept of TOSI is a lot like these escape rooms that you guys might have been involved in. You're kind of, you're caught, you're trapped unless you can find a way out, right? So there are exceptions to the TOSI. And if you can get out the side door or find one of these exceptions, then you could potentially access family members' lower marginal tax rates. So in looking at real estate agents specifically, there's two particular exceptions that I wanted to bring to everybody's attention that might be relevant to you. The first is something that I'll call excluded business. And so essentially for this to apply, the family member's got to be 18 or over. They've got to be actively engaged on a regular and continuous basis. And so when the rules first came out, there was a lot of ambiguity about, well, what did that mean? What does regular and continuous mean? And so what finance has come up with is kind of a bright line test that says, if you work more than 20 hours per week in the business, you meet this test and you can receive a dividend without the application of TOSI. Now, what's really interesting here is that they don't define what type of work is required. So, you know, we've got clients, we've got one guy who's actually a brain surgeon. So somebody could be doing brain surgery for 20 hours a week, or they could be assisting in all the good stuff that you guys do, whether it's, you know, putting signs out on corners or coming up with pamphlets or advertising, these sorts of things. The key takeaway there is that it doesn't matter what that family member is contributing towards, only that they work a certain number of hours per week. Something to be aware of. The other thing is that there's an exception where the active spouse is 65 years or older. In that case, dividends can be paid to their spouse regardless of the spouse's age. And so the reason for this rule is that, you know, public servants who receive a fixed pension working for the government, there's rules in place that allow them to split their eligible pension income with their spouse in retirement. And so again, this is something the government, they kind of threw us a bone as in the private sector to say, well, wait a second, if you're incorporated, you should be able to stockpile money, so take advantage of this income tax deferral that I mentioned. And then in retirement, you should be able to split that income with your spouse once you're 65 or over. So for anyone listening in, it may or may not be relevant today for the 65 or over test, but in a long-term view, if you were to take advantage of the income tax deferral, it is something that could be very beneficial to you and your spouse in retirement. So there are some other benefits of incorporation. Probably the main ones we see are something that's called the lifetime capital gains exemption. If you meet certain conditions and you're able to sell your shares of your corporation, that capital gain that would otherwise result on the sale can be sheltered from the capital gain, and tax is therefore avoided. So the prospect of you guys doing that with a PREC is probably somewhat limited, but just to make you aware, that is a potential benefit depending on the nature of your business. The other thing it allows for is the transfer of wealth or the transfer of your business to another generation, whether it be a family member or to an arm's length person. So as an example, if you wanted somebody to kind of partner up with you maybe and take over 50% of your business or 30% of your business, it's a lot easier to sell a certain number of your shares to make that happen, rather than trying to somehow introduce them into your sole proprietorship down the road. That can be kind of a messy thing. So corporations do facilitate a succession of businesses as well. And with that, I'm going to pass it back to Andy. Andy's got a great slide here that hopefully will kind of summarize much of what we've talked about thus far.
Yeah, so getting into the personal real estate corporation rules, you know, this slide, you know, is good because it really sets forth the relationship between the PREC, the realtor, and the brokerage. And I think the best way to think of this is, and we'll go over some of the, you know, some of the language and the regulations next, and a lot of it's going to be repetitive, but your personal real estate corporation is essentially offering up the realtor who established it as the realtor that will enter into the employment relationship with the brokerage, which you probably already have. And then instead of the brokerage paying the commission back to the realtor, the brokerage is actually paying that into the personal real estate corporation. And so there's actually a requirement in the legislation for a tripartite or a three-party agreement between PREC, realtor, and brokerage. And so, again, with the realtor providing, the services of the brokerage then providing the compensation into the PREC, it stays here at the corporate level, and then the realtor can draw a salary, the realtor can, take a dividend, the realtor can do income splitting potentially with another shareholder out here. There might be a hold co over here where it could send out a dividend, intercorporate dividend that'll pass tax-free to the other corporation for investment purposes. It can actually do some investing right inside the personal real estate corporation. So there's a lot of flexibility when it comes to this, but this slide really captures a lot of, the concepts and the rules that are set out in the legislation and the regulations. And I'll explain it in a different way. This is, some of the language taken right from the regulations, but as I mentioned, the PREC provides services of its controlling individual, the realtor, to the brokerage. The PREC itself does not trade in real estate. That's important to recognize. And no stakeholders, the realtor, its employees, et cetera, can indicate to the public that the PREC trades in real estate. That individual must be a registered broker, salesperson must be employed by a brokerage, as I mentioned before, and it manages and supervises the business and affairs of the corporation. The PREC cannot carry on the business of a brokerage. The PREC only receives remuneration with respect to trading in real estate from the brokerage. That's not to say that the PREC can't have as an investment, an income property, and some rent is being paid into the PREC. That's not what this is saying. Just with respect to anything that's remuneration from trading in real estate, that needs to come from the brokerage. I mentioned the three-party agreement between brokerage, individual, and PREC that your corporate lawyer would set up for you. One individual must own all the equity shares and be the sole director and president of the PREC. So up here, the realtor is going to be the sole director and officer, and also the sole equity shareholder of the PREC. But family members may hold non-equity shares. So, the realtor's spouse, children, and parents, which is, a lot of flexibility and a really important provision in these regulations from a tax planning standpoint for all the realtors on the call here. Notice must be provided to RICO in prescribed form, just with respect to the name of your PREC, and obviously to establish that understanding that the fact that the realtor intends to operate this PREC. The personal real estate corporation cannot receive remuneration for trading real estate from any other person or entity other than the brokerage. And the controlling shareholder, the realtor, cannot receive directly or indirectly remuneration for trading real estate from any person or entity other than the PREC or the brokerage. So realtor is not going to accept money from anything other than the brokerage or the PREC with respect to trading in real estate. And lastly, the PREC does not, on behalf of the brokerage, directly or indirectly hold any money or other property of a client, customer, or other person in connection with trading in real estate. So those are some of the rules and regulations to ensure that the PREC is operating on side of the regulations which have been passed to allow it to continue as a corporation. And Jacob and I are also available right now for any questions anybody may have regarding the personal real estate corporation regulations. And otherwise, you're welcome to contact us. If you wanted to incorporate, that's something that we could do on a pretty quick turnaround basis, and we could hold Zoom calls to get instructions. And obviously Jacob and I work closely together, and I think it would be a real seamless process. So over to, I guess, back to Andrew. Andrew, if there's any of the realtors that have any questions, perhaps I can fire away.
I got a question for you. I just want like in terms of the PREC owning real estate. So can I use that to purchase an investment property, or more importantly, can I use that to purchase a building that I want to have my, you know, real estate team in, as an example? Is that a possibility?
It is a possibility, and it's actually allowed under the rules. This personal real estate corporation, Chris, could own it, but there might be a situation where, and Jacob, you could talk about passive income and how that could impact the small business deduction, but it may make sense from a tax standpoint, Chris, depending on how much revenue is going to be coming in. You don't want to go offside and lose access to the small business deduction. So you may want to set up a holding company. In fact, if I go up to one of the first slides we had, you could own your shares personally here in the PREC and also have a holding company, and you could actually send some of the revenue here into, and it still wouldn't come into your hands. You could send it up to your holdco as an incorporate dividend. It'll pass tax free, and invest in that real estate from your holdco, you know, which is a separate corporation. But Jacob, maybe do you want to tackle that one part of it, the tax part?
Yeah, so Andy, do you mind flipping to the slide on the income tax deferral?
Yeah.
Back one. Yeah. So I mentioned that the tax rate applicable to corporations. So the first $500,000 of active business income is 12.5%. Anything over 500,000 is taxed at a rate of 26.5%. The main exception to that, you notice the word generally. As a tax person, I always like to put the word generally in there. There are rules that say, well, if your passive income being in your corporation exceeds $50,000, so these would be interest and dividends and these sorts of things earned on your investments, or if you bought a rental property, the net rental income that's being earned on that rental property. This would qualify as passive income to the extent that your passive income inside your corporation exceeded $50,000. Your ability to access the $500,000 small business rate at the preferred corporate tax rate would be diminished. There is planning that can be done there, and Chris, I'm happy to speak with you offline about what that might look like in your circumstances, but there is planning that can be done. But part of the discussion I'd want to have with you is perhaps, are we that worried about it? Because one thing to note is that if you are subject to the 26.5% corporate rate, ultimately when the money comes out to you in the form of a dividend, you'll get a preferred rate on the taxable dividend that comes out if you pay the higher corporate tax rate. So presuming you're going to take some level of dividend income, it may not be that big a deal to be subject to, you know, what on the surface is a 14% higher corporate tax rate. When all the dust settles, your overall tax rate won't be that much worse off. So I don't know that it would be that big of an issue. It would be something that I'd want to chat with you about, however. And then the only other thing to note there is, you know, Andy talked about a holding company. Just a logistic thing you might want to think about is that if that building that was, you know, I don't know if it's going to be jointly owned with anybody, certainly it may be a case where you'd want to have that in a separate corporation so that you and or multiple other people could hold shares in what would be a separate company, rather than trying to hold that within a PREC, to which we're a little more restricted on who can own those shares.
It would also help for liability, right? Like if someone slipped and fell in the investment property, couldn't affect the PREC, right?
It's a really good point. Yeah, yeah, and that's one of the other reasons why, you know, sometimes people that are investing in real estate have multiple corporations and they try to set up one for each. But yeah, that's another good reason.
So we do have a couple questions in the chat as well. Are common law relationships, do they qualify for income splitting?
Yeah, really good question. Maybe Jacob, you can cover that one off.
Yeah, so from an income splitting perspective, with what I would call a regular corporation where there's no restriction on who the shareholders are, you can literally name anybody you wanted. So it could be a girlfriend or boyfriend, it could be Uncle Fred, it could be your neighbor if you really wanted to. Specific to PRECs, you're a little more limited. It has to be a family member. And so it's tied to, I think, a child, a spouse, or a parent. And so for income tax purposes, a spouse does include a common law spouse. So yes, you would be able to include a common law partner for the purposes of income splitting.
Okay, the next one here is person already has a corporation. Can that be converted to a PREC? So Helen, the first thing I would check is whether or not your current corporation is registered federally or provincially, because it has to be registered provincially. And then I'll let you guys go on from that. But
yeah. So that's actually allowed. Ori made a point of lobbying for that particular right. So if you guys have a corporation set up, as long as you're going to amend the articles or change the structure or the shareholders to make sure that you fit within the requirements under the PREC regulations, then you're fine. So as long as, it can be continued, and even if it's in a different jurisdiction, you could continue it if you get it into a provincial corp, continue that under the Business Corporations Act of Ontario, and there should be no issue. We can help with that too.
Can you repeat the last part? So if someone had a federally incorporated one, as long as they were able to, they can make that register it provincially somehow?
No, but if they had a provincial corporation that was extra provincially registered, let's say in Manitoba, and they were just doing business there and they wanted to continue it here, they had some investments, then they could do that. It's as long as it's incorporated under the Business Corporations Act of Ontario.
So you can't take a federal one and do anything with that?
I don't think so. I know years ago we actually had a situation where, Jacob can probably talk to this too, but when you amalgamate a group of companies, it's extremely difficult when you have a federal company and a provincial company, and because you want, the opportunity to amalgamate is really subject to being under the same terms and conditions, under the same laws. And so I remember there was something years ago where we had to somehow flip a company into a provincial corp and make that work. But, again, the filing fee is $300 to incorporate an Ontario company. So, by the time a corporate lawyer spends more than an hour on this, you're already losing money in terms of whether to just go in that direction. So I think perhaps the simplest thing might just be to incorporate a new Ontario company.
Okay.
The analogy I always like to give is, if you're installing a sink in your kitchen and it's a brand new build, you get the plumber to come in and do the plumbing for that sink, and it's fairly straightforward because you know exactly what you're trying to do. But if you've got an existing kitchen and you're saying, well, now I want to move the plumbing to the other side of the room, sure, you can make that work, but it's almost more work than just starting over and saying, well, let's just incorporate the company from scratch. That said, whoever posed that question, I mean, we could look at that with you and see if it makes sense to recycle that existing company versus creating a new one, I guess.
Okay. So the next question is, when you're transferring it over, we've heard a lot of bewares about having the company value, your real estate company evaluated, and how you might have to pay some taxes as you turn it into a PREC. You have to I guess you're supposed to sell your existing company to the PREC or something. I know, Gary, you've looked into this a fair bit. You want to elaborate on that and make this question more coherent? Oh, you gotta be unmuted to be coherent. That's a key part. I got that one.
There you go.
Oh, no, you still can't hear you, Gary.
I think I know what he's referring to, but I'll let him go ahead if he.
There you go.
Hi, Gary. Go ahead.
Yeah, sorry. You would think I know how to use Zoom after all this time. I think what you're alluding to there, Andrew, is the rollover of your current business, whether it be personal or in a corporation. Is that what you're getting at? And having that evaluated into the new company.
Yeah, essentially.
Okay, yeah. So,
Yeah,
yeah, do you
so
want to take that, Andrew, Scott?
yeah, so under the Income Tax Act, there's a mechanism to allow for you to take the assets that you have in your sole proprietorship or partnership and roll those into a corporation on a tax-free basis. And so that shouldn't be a problem at all. And to the extent, I even talked to Chris a couple of weeks ago, just regarding, what are there any real valuable assets that, a realtor has in his practice? And really, I think the answer was no. There's not a significant amount of really valuable assets, but to the extent that there were, we can look at, for sure, rolling those into the corp on a tax-free basis. And myself and Jacob have done that many times. But in fact, one of our mutual clients did that very recently. But, Jacob, can you elaborate a little bit on that maybe?
Yeah, so I think anytime we think about assets being transferred, so the key to remember here is that your corporation or your PREC and yourself, you're two distinct taxpayers. And so as silly as it sounds, the government says, well, wait a second, what you're really doing is selling assets from one entity to another. And typically, anytime you're selling an asset, it's going to create a tax issue, right? You're selling an asset for some kind of consideration. Now, when we think about the assets that you guys might have, they're going to be your desks and your computer and what have you that you're using in your business. I think we'd all agree that those hard assets may be somewhat limited in terms of value. Maybe a vehicle if you wanted to consider rolling that in. But the biggest one that we often see is the intangible asset, something called goodwill, right? And the goodwill is really, if an arm's length person came and wanted to buy your business, what would they pay to buy that off you? So over and above the cost of the chairs and the computers and whatever else, how much money would they fork over? And that delta is something called goodwill. So the sale of goodwill generally would trigger a tax event as well. And so to Andy's point, there is a tax election. We can roll that goodwill into the corporation and say, even though maybe it's worth $100,000, we're going to elect for the purpose of the special election that transfer happen at a nominal amount, let's say $1. And by doing that, we're papering it such that the goodwill can move into your new corporation with no tax event happening. Now, I'm not a business valuator. I can't comment with certainty that, this is a big deal in terms of what is that goodwill worth. I would suspect, however, that for most agents, like if you're just, you got your picture up on your sign and it's really you that's branding your business. Well, if I'm another agent and I want to come along and buy your business, unless you're coming along with that business, it's unlikely that there's a huge amount of goodwill there. Certainly it's something we'd want to consider, but I think we may be able to take the position that goodwill value is low, such that maybe this requirement of documenting everything in terms of the special election may not be as important in a lot of cases. If you feel differently and you think, hey, I think I could sell my business for a premium, then we would want to be looking at a special election and some more planning involved with that.
Thank you very much. So here's some more questions. Are there any restrictions on naming the PREC? I believe the answer is no there, but I'll let you guys confirm that.
Yeah, that's right. There's no restrictions in the regulations with respect to naming, but at the same time, there's a requirement with the Business Corporations Act that a name is not going to be confusingly similar to other names in Ontario. So you can't have the same name as somebody else. And so we would ensure that the name has not been taken and file that request as part of the incorporation process.
Okay, and the next question, I'm going to skip over one, John, come back to it at the end here. Jean Richer is asking, income generated before the PREC was formed, can it still be paid to the PREC? So for example, if they've already done the transaction and it just hasn't closed yet. So it's firm, the sales firm, and it hasn't closed yet. Can that income still be paid towards the PREC? I'll let you guys answer and then I'll give you my view.
Yeah, it's a good question. You know, it's not something that I've spent time analyzing. It's, you know, in legal jargon, it's the type of question we bill you for. I'm just joking. So the way I look at it is this. I go back to this slide because the realtor and the brokerage have an employment relationship, and really there's a number of hoops to jump through before you can have a PREC that is onside the regulations, one of which is that tripartite agreement between PREC, realtor, and brokerage. If you were in a situation where you you know, did some work and the deal hasn't closed, the commission hasn't been paid, and you get all of your ducks in a row, and you know, you're incorporated, you have the tripartite agreement, you know, you've issued your shares, you've signed all the resolutions, and you're properly set up, then I think you know, the initial position we'd have is, yeah, you know, if we're all set up and the commission hasn't yet been paid, why not just pay it into the PREC? That would be my initial position on it. And Jacob, I mean, you deal with CRA a lot more than I do, and I know they poke and prod, you know, quite a bit. And, you know, the question ends up being, well, when was that commission earned? You know, they could come up with that argument. But again, you know, I take that position, especially if I'm acting for the realtor, and go from there.
I would tend to agree with that, Andy, that I'd probably recommend taking that position. It is a bit of a gray area, right? What is the perfectly correct answer? Unfortunately, I don't think it's a black and white answer. So you know, in terms of advocating for clients, I think taking that position would be the way to go. The advantage of that, of course, would be, I talked about the income tax deferral, in the sense that if you retain money inside the corporation, it's going to defer the personal tax. The other element of deferral here, and I didn't talk about this in the presentation, is that in the year after incorporation, the company can basically pick any year end it wants. And so a lot of people intuitively will pick December, right? Which means the taxes would be due 6 months thereafter. So it'd be due June 30th. But there is a possibility to choose an off calendar year end. So if you were incorporated on October 13th, you might pick a September 30th year end date for your corporation. And what that's going to do is it's going to buy you 9 additional months of tax deferral, because now you're going to have income landing in that corporation in October, November, December, that you don't have to file a tax return for until after September 30th next year. So that is one additional benefit. If you were able to land more income in the last part of 2020 in a corporation, you gain an additional deferral advantage.
100%.
So I would have thought, again, understand it's gray, that we wouldn't have too much issues with basically using cash basis instead of accrual basis accounting for this, because that's basically how we're filing our income tax currently, right? We're not paying income tax on deals we've written and haven't received for personally either, right? It's basically all on basis. So I would think that's a strong argument for whether or not you're able to basically do the cash basis accounting for the PREC as well, since you're already doing it for your personal. Anyway, that was my thought.
Yeah, and I would tend to agree. And I think as long as we can find a way to get the company incorporated and a bank account opened, so because ultimately we want the money being deposited into the PREC bank account to show that as PREC income, I think yeah, it's a good position to take.
Andrew, I have a part A and a part B kind of question. It's for both Andrew and Jacob. So first of all, I think this is amazing, and it certainly would encourage our people to come out and see you if this makes sense about doing a personal real estate corporation. So the part A question is, I think the real value in this is incorporating a holdco to go out and buy investment properties and so forth. So number one, if they have that intention, I think most people should. would you recommend doing so at the same time that you're doing their PREC, incorporating the holdco? And number two, or part B, I suppose, would it be more advantageous to have an offsetting year end for the holdco? I know that I have several corporations and they have offsetting year ends, and it's been very advantageous to do that. So it's kind of a question for both of you, I think.
Yeah, maybe I'll take A, and maybe Jacob, you can take B. But in part A, I find, Marvin, with my experience in incorporating so many businesses over a really long period of time now, 15 plus years, the reason why I think you should get it done right away is because just like, you know, getting your will done or getting you know, all these other things from a legal standpoint done, it just falls by the wayside if you don't get it properly structured on day one. And then you run into a situation in a year or 2 years, and again, if you hold everything in the PREC, much to Andrew's point earlier on, you know, it becomes a whole lot more difficult to now get those properties into another corp, or perhaps at that point you are gonna, you know, not dissolve the PREC, but get the PREC operating more like a holdco, and then you're gonna incorporate a new PREC, and now you got to talk to Rico about the fact that you've changed PRECs and now this is the proper PREC. And I would, for many reasons, set it up the way you want it to be set up on day one. It's, in the grand scheme of things, a small price to pay to know that you're set up properly. And you know, again, I think that the legislation is so enticing compared to other professional corps to have the ability to even have a holdco as you know, right, to have holdco owning shares of the PREC in itself is a big win. I think realtors really need to take a long look at it and take advantage of the provisions that have been, you know, lobbied for and provided by the government.
I would agree with you, Andrew. And I think that's the whole point I think I wanted to make as well. So I would encourage our realtors to speak with Jacob and with Andrew, because your vision right now is what's really going to matter. It's not even where you are at this moment in time. It's where you intend on this going. So I'm in total agreement. I think this is the time to figure out your vision of how this is going to look for you, not just now, but in the future. And I would incorporate as necessary whatever you need to do to Andrew's point. So thank you for saying that. That's great.
Appreciate it.
In terms of the part B to that question, Marvin, basically the question of, well, does it make sense to have different year ends other than December 31st? And I would say absolutely. And that decision is often dependent on your circumstances. Some people, you know, taxation is a complicated thing. And, you know, again, it's one of these things where they want to deal with once a year. And so for folks like that, a lot of them will lean toward a December 31st year end just because it's intuitive, aligns with their personal tax filing. They can come see me at once, get their personal and corporate done. So there is merit to just picking a December year end. There's reasons for not picking a December year end, and the ones that come to mind are deferring that first tax filing as long as possible. So, you know, paying myself or some other accountant to do a 3-month return up till December versus deferring that one full year may be an attractive thing just from a dollar and cents perspective in terms of value you're getting. There's opportunities to monkey around with bonuses and other things that may fall in different tax years depending on the year end that you choose. And probably the biggest one is non-tax thing to consider. I wouldn't encourage anyone, like if your busiest season is the spring, so May, June, and April maybe is when you're doing most of your selling. Don't pick an April 30th year end, because then, you know, your accountant's going to be barking at you and saying, why haven't you got me your stuff yet? And you have 5 million other things on the go. Maybe pick a year end where you're less busy, so you have more time, you know, to kind of focus your attention as necessary to the tax stuff. So I think it is a good point that don't just assume it's going to be a December year end. There's other factors to consider there in terms of choosing what is the right year end for you.
No, that's excellent. Thank you.
Any more questions at all, Andrew?
Yeah. So there's one that's for us of what will KW require from us. So I'm going to get to that next. The next one I think that's for you guys is Is it recommended to have a hold company for other investments, i.e. stocks, mortgages, and so on?
Is it recommended to have a holding company for other investments?
Yeah.
Yeah, I mean, similar to the last question, I think that, to have a holding company, I think what everybody needs to understand is that intercorporate dividends pass tax-free. And so when you have a holding company up here at this level, so you have a holdco here, and you have your PREC, you can send a dividend to this holdco on a tax-free basis and then invest from the holdco. You can invest in income properties, you can invest in Bell Canada, you can invest in Shopify from here, and it does make some sense to have that. Jacob talked earlier about some of the tax reasons, but also in terms of having a separate holdco that is not intertwined with your personal real estate business, it does make some sense. One thing that's really important, and I don't want, I talked about limited liability on this slide. I want to make sure that everybody understands that the one thing that, might be a little bit different about personal real estate corporations when compared with corporations relating to other professions is that the realtor and the brokerage, this realtor is still registered with your association with RICO, and it still needs to have individual insurance. Like, that's not going to change. You're still out there holding yourself out and trading in real estate, working for your brokerage. And so there isn't that, limited liability of this realtor because, there's now the opportunity to incorporate a PREC. That's a really important thing to understand. That insurance needs to continue, and you're continuing to work for the brokerage, but yes, does it make more sense to have it in a holdco? Is that the ideal structure? Is that a better structure compared to having it in the PREC? In my opinion, it is. But you can also own Bell Canada shares right inside your PREC and have various investments right inside your, this personal real estate corporation as well.
It's interesting too, Andy, because the way I see it is most of the income for most people on this call is going to be derived from their real estate business via payment to their PREC. So because you can do an intercorporate dividend transfer, the holdco that would be owning, let's say, a real estate investment, a building or a house or something, the interest component of that mortgage payment is totally tax deductible. So to me, the idea would be to move as much income that you have in the PREC through a dividend to a related corporation like your holdco, have that own a property, and then of course any income that you get from that rental property is going to be offset by the interest component of the mortgage. So I think it actually saves in multi-layers by doing the holdco as well. Not to get too complicated for everybody, but there's definitely additional benefits there, right?
That's a really good point. Margaret, once you get into the weeds, I think there's more and more, value in setting up that holdco for a lot of investment reasons. Yeah.
So the last question that is on the group chat is, what does KW require in order for the agents to kind of get set? And I'll start that, and then Marvin and Gary, if I miss anything, please jump in. I think the first thing that the thing that's, let's say, holding up this process right now is the three-way agreements. So we need a document that outlines a three-way agreement between the realtor, the brokerage, and the PREC. And we're now, I'm sure Marvin finished that 2 minutes ago, right, Marvin?
Well, essentially what we've been doing is gathering information at this point because we want to make sure that we do things correctly. I fully anticipate, and I see David in the background there. His hands, I hope they're not on a gun because I know he can get that stuff a lot. We want to make sure that it gets rolled out correctly because we know that there will be the periodic RICO audits to make sure that things have been set up correctly, and potentially even CRA audits, although I think the RICO audit's probably the more prevailing concern at the moment. But so we want to make sure that we have everything done correctly. So we're developing a checklist, and we've got experts like Andy and Jacob available to us, which is wonderful, to make sure that these are the things we should be looking for when a request comes in to be paid through their PREC. So we're in the process of gathering that information right now. And once we have a good handle on it, then we'll make an announcement saying, here's the documentation we require from you, here's the checklist, and then we can move forward once we get that worked out. So the answer is no, I don't have anything ready yet, but this was an important part of our information gathering. So I really appreciate Jacob's and Andrew's time. So thank you.
So if you guys are looking to get your ducks in a row while we're getting our three-way agreement finalized for you, you're going to need, basically we're going to need you to provide us with your incorporation documents. Okay, your incorporation documents are going to need to show you that you're the only you're the only person holding voting shareholders as the registrant. Okay, that that there's no other shareholders other than family members, etc. We're going to need at one point, when everything's ready, three-way agreement signed included, when you're registering your incorporation with RICO, you have to send them an email to the registrar at blah, 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 that shows your address for service, the name of the corp, etc. We're going to need a copy of that email, and we're going to need your banking information. So those are some of the main things beyond the agreement that we're going to need from you. We did get one more question as well. Actually, there's two more here. Is there a scenario where a PREC is not a good idea? Perhaps someone who lives on their income and does not have excess money.
Yeah. So I would say incorporation is not for everybody. If you think back to the 3 reasons I talked about corporation being advantageous from a tax perspective, it's really the income tax deferral. So if you're able to stockpile money and leave it behind in the corporation, if you have some ability to smooth your income, maybe you've got lumpy income that you can better monitor your personal income, or if you've got a family member to which you can income split with to take advantage of lower graduated tax rates amongst the family. If you can do any of those 3 things, incorporation likely makes sense depending on the circumstances. But if your answer is that literally every dollar you're earning you need for personal reasons to live, I would say don't bother incorporating, because when you see your accountant every year, you're going to say, well, what was the point of running out and incorporating? I have no savings. And I would say, yeah, I would agree. So save your, if that's your circumstance, save yourself the headache. And know that you can always incorporate down the road. So maybe your circumstances will change such that you don't need every dollar you're earning. You can always incorporate in the future. And so for now, if you are in that circumstance, I would hold off.
Yeah. Agreed. Totally agree. You know, we had another presentation that Jacob and I did, and a realtor called us right after and had the exact same question, and we had, you know, the very same answer. It doesn't make sense if you're just making enough to live on to have the corporation, because again, the theory of integration, it goes into the corporation, you're paying yourself anyway, it's going to be the same tax result.
Christine, I don't know if I want to ask the last question there, because I don't know if I really want to know the answer. The question is, can the brokerage hold a pending income until the PREC is set up?
I see you asked that question after David left the room with the gun in his hand. Yeah, smart. So look, I think that one of the things that we're always very careful of is holding any kind of money going into the next fiscal year for us. So our year end for both companies is December 31st. So we never want anything rolling into the next calendar year for us, our fiscal year as well. So that's the first and foremost thing. If it's deemed that the payout is sort of the benchmark for when that money can go to the personal real estate corporation, and if the transfer is going to take place before December 31st, I don't see any reason why not. However, we won't be able to hold money earned in 2020 personally and then move it over to 2020 and 2021 to a PREC. It's going to screw up our accounting. That's my initial answer anyway, Andrew.
Thanks for taking that one, Marvin.
Yeah, it's not the one I wanted, but there you go.
This is where the accountant just does this. La, 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 la.
la la.
Yeah, I got you. Yeah, I got you. So, I mean, we do some, we don't call it tax withholding, but agents can actually opt into deducting a certain amount of money from their commissions earned. And when they request it, we issue it to them. We don't say it's tax withholding because we don't want to create an employee-employer relationship. It's not that. It's, you know, they've requisitioned money to be held back and they use it for whatever purpose they want. Buy a car, pay their HST, pay their tax, go on a trip, whatever. So the only stipulation we have with that is that the funds have to be taken out before the year end because we don't want to mess up our accounting, holding someone else's money going into the following year. So I'm assuming it would be a similar thing with this, Andrew, but would have to work it out. And Christine, no further questions from you, please.
Yep. All right. I don't see any more questions. We'll give a kind of like final, get your questions in 5, 4, 3, 2. All right. Thank you very much, Andrew and Jacob. That was excellent. Much appreciated. And I will get you the list of everybody who registered and attended so that you could reach out and make sure everybody has your contact information and all that. We very much appreciate your time. And I thought that was great. Thank you very much, everybody.
Thanks for having us. Appreciate it, guys.
Thanks very much, guys.
Andrew, Chris, thanks, guys. That's great. Gary?
Thank you.